Welcome to the Riskwiser Zone, the show where we dive into the world of finance and help you make informed decisions about your money. I'm your host, Lewis, and we're excited to have you join us today. As we navigate the complex landscape of personal finance, it's essential to understand how credit cards work and the impact they can have on our wallets. Credit card interest rates are near all-time highs, making it more crucial than ever to be aware of the terms and conditions associated with these financial tools. On today's show, we're going to explore how credit card interest works, what APR means, and most importantly, how you can avoid those hefty interest charges. Whether you're a seasoned credit card user or just starting to build your credit, this information is vital for making smart financial decisions. We'll be discussing topics such as introductory, 0% APR promotions, balance transfer rates, and penalty APRs, all of which can significantly affect the overall cost of using a credit card. Our goal is to provide you with a comprehensive understanding of credit card interest rates, enabling you to compare different cards and find the best option for your needs. It's also important to note that excellent credit is key to securing the best credit card interest rates. By maintaining a good credit score, you can unlock lower interest rates, even as low as 0% for a limited time, helping you save hundreds of dollars in interest charges over the life of the card. Throughout this episode, we'll offer tips and strategies on how to manage your credit effectively, avoid interest altogether, or at least reduce your interest costs. From paying more than the minimum payment each month to using balance transfers wisely, we'll cover it all. We have a lot to cover, and by the end of this episode, you'll be well equipped with the knowledge needed to navigate the world of credit cards with confidence. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, where we're navigating the twists and turns of the financial world. Today, we're focusing on a sector that's been making headlines lately: private credit. The $1.8 trillion industry has been under intense scrutiny, with concerns about its exposure to risky companies and the potential for a bubble bursting. Now, I know some of you might be thinking, private credit? Isn't that just a fancy term for lending money to companies that can't get it from traditional banks? Well, yes and no. While it's true that private credit firms often lend to companies with lower credit ratings, the industry has grown exponentially in recent years, and it's now a major player in the financial landscape. But as we've seen recently, this growth has also led to increased scrutiny. Companies like Blue Owl Capital, Apollo, Ares, BlackRock, and KKR have all faced redemption requests from nervous investors, with some firms capping withdrawals to prevent a run on their funds. In fact, Blue Owl's Credit Income Corp. fund saw investors asking to withdraw 21.9% of its assets between January and March, while its tech-focused Blue Owl Technology Income Corp fund faced an astonishing 40.7% redemption request. Now, I'm not here to sound the alarm bells just yet, but it's clear that investor anxiety is running high. As JP Morgan's Jamie Dimon put it, there may be more cockroaches lurking in the private credit space, waiting to come to light. And with the average software exposure of business development companies sitting at around 15% to 20%, according to an iCapital analysis, it's no wonder investors are getting jittery. But here's the thing. As we've seen time and time again in the financial world, sentiment can shift quickly. What looks like a crisis one day can become a buying opportunity the next. So, while it's essential to keep a close eye on developments in private credit, let's not jump to conclusions just yet. As the first always say, where do you stay your money Monday? It's a question that's more relevant now than ever, as investors navigate this complex and rapidly changing landscape. So, take a deep breath, stay informed, and remember that the elves, our technical analyst friends, are always watching the charts for signs of what's to come. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to bring to your attention a fascinating development in the retail space that could have significant implications for consumers and investors alike. You may have heard about digital shelf labels, but what you might not know is how they're being used by major retailers like Walmart. These labels are essentially electronic price tags that can be updated in real time, allowing stores to change prices quickly and efficiently. While this technology has the potential to improve operational efficiency and reduce errors, it also raises concerns about dynamic pricing, also known as surge pricing. For those who may not be familiar, dynamic pricing refers to the practice of adjusting prices based on demand, competition, or other factors in real time. This can lead to price fluctuations throughout the day, which may not always be transparent to consumers. Walmart has stated that its digital shelf labels are not being used for dynamic pricing, but rather to improve efficiency and ensure consistent pricing between the shelf and the register. However, the company does have a patent for updating item prices on its e-commerce platform dynamically and automatically, which has raised some eyebrows. Other retailers, such as Amazon and Kroger, are also exploring digital pricing tools, and some have already begun using them to adjust prices online based on demand and competition. So, what does this mean for consumers? While it's still early days, it's essential to be aware of the potential for price fluctuations and take steps to protect yourself. You can start by tracking prices of your staples, using store loyalty apps and price scanners to confirm prices at checkout, and shopping during off-peak times. Lawmakers are also taking notice, with several states considering legislation to limit or regulate dynamic pricing, particularly when it comes to personal data. As investors, it's crucial to stay informed about the evolving retail landscape and the potential risks and opportunities that come with new technologies like digital shelf labels. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.